3, 2, 1. Live. Am I live? Am I live? There I am. Just had to check the YouTube live streaming app, which is really embedded into a web. In any event, how you doing, friends? Ernie here, and this is the 69th episode of the 0 Days to Expiration podcast. And today's topic is timely, volatile, purposeful, and definitely in context with what's happening today. The title being, "You Won't Get Burned Playing Too Close to the Fire." Now, today was just a crazy day. And for those that are listening to the podcast, and if you're listening to this afterwards, it is Monday, January 10th. And today was a remarkable day. I don't know how else to put it. The index, the S&P, gapped down. Now, if you're looking at the index, it gapped down, 30 points, maybe more, 30, 40 points, something crazy like that. And on that gap, then it moved down another, 50, 60 points. And then right around 10:30, 10:45, it did an about face and made up that 50, 60 points right up to the bottom of the gap. And now it seems to have stalled there, and not sure if it's going to break through and then regain the previous high or the previous close or not, or if it's going to move back down. Nobody knows. But one thing is for sure, volatility was elevated dramatically. And then we had a term known as volatility crush. Once the market reversed, all that volatility just seeped out of the market like it wasn't even there. And so trading a day like that, obviously, for most people is going to be completely hectic. You could be totally out of your mind. Do I go long? Do I go short? Is it going to keep on going through my target? What do I do? And so what I'm going to say, now I know that people within my service are looking at today's trade and saying, man, this is crazy. It looked like we were in profit, and then it goes right through, and then it reverses, and then, and you put a couple of positions on hoping to capture the price at some point, and it seems to be there, and, only if it just stayed right there, let the premium decay and we'd be great. And then it moved through, and, there's still a potential for it to come back down right into our profit zone and make a fantastic day. Now, it could end up being fantastic, or it can end up not being so fantastic. Now, we are in a day that is without a doubt one of the most volatile days that you'll see in any trading day, other than like a flash crash or something like that. I mean, this is almost like a flash crash and then a flash recovery. But the day's not over yet. We're sitting here at 3 o'clock. There's still an hour left in the day. No one knows what's going to happen. And it's Monday. Monday is like one of those days everyone's just sort of getting into the week. It's not like there's any economic reports. The Fed is behind us. Last week was a disaster when it came to Fed reports and employment situation. It was horrible. And that probably accounts a lot for that gap down and the move that we had. Now, we relish days like today because of the increased volatility. The increased volatility, what that means for us is that we can take extra chances. We can put on wider spreads. We can put them further out of the money and potentially collect much more profit. And at the same time, we can create a risk profile that is remarkable. So in other words, we could put on trades that are, 1 to 8 or 1 to 15 or 1 to 20 risk to reward. Now our standard is not to put on anything less than 1 to 5. But when you have an elevated volatility situation and the type of trades that we put on, which are vega negative and theta positive, what that means is that these trades do better when volatility is going up. However, it also means in the inverse that they're best to put on when volatility goes down. In the inverse, they're best to put on when volatility is up, because the whole idea is that you want to put the trade on with lots of premium built up into the trade and then take it off as that premium decays. And one would expect as you get closer and closer to expiration, that premium would decay. So that allows us to put on trades that have very little risk with huge profit potential. The good thing about that is, yes, there's huge profit potential, and if it goes against you, if you control your risk and you make sure that just because it's a volatile day, you're not just throwing all the chips in there thinking that you're going to make a home run, you can control your risk. So I never veer off from the amount of risk that I'm willing to take in any particular day. And depending on which account I'm talking about. If I'm talking about my small reference account for the service, never take more than, say, 2.5 to 5% total risk. So the account is never in jeopardy for more than 2.5 to 5% of the account. It's a small account. It's under $10,000. In my large personal account, which is much larger than that, I'll never take a risk more than, say, 1.5 to 1.75%. In most cases, when I first put on an initial trade, I start off at maybe 0.5% of risk. So given that, that's how I structure my trades. I figure out how much risk, or how big of a trade, how wide of a trade, how wide of a spread can I create, and how much potential profit can I get while keeping my risk at that level. Can I put on a 1 to 5 trade and keep my risk at less than 1.25 or 2, depending on the size of my account, that maximum size? Can I put on a 1 to 5 risk to reward trade, and will it be reasonable? Will I be within the ballpark? Can I say that, okay, price is likely to go there? Of course, we never know what's going to happen. Most days are a little bit more under control than today. Today was just totally bonkers. But even in that case, when you have a bonkers day like that and you have elevated volatility, that means that you also have elevated premium. So that means in a vega negative trade, you can put on a better risk to reward. And so you're rewarded for that by taking a potentially larger gain. I can also, conversely, have a smaller risk. I know that sounds odd, but there's also the fact that there may be a lesser probability that I'll profit too, because no one knows where the hell the price is going to go. It can go anywhere, and usually does. So that's the great thing about trading zero DTE. First of all, we only have a small window of time that we're putting on a trade. And we don't know what's going to happen that day. We do our analysis. We look for a catalyst in the market. We look for the momentum and see where price is likely to go. We analyze the volume profile and look at what the market structure is, come up with scenarios. And our scenario, by the way, for today was spot on. We picked where the price would come down to each individual level. Now, beyond that, we thought, okay, once it got down there, that was as much as our brains can handle. Will it come back? That's something that you can't really predict, like what happened today. But in any event, we picked the levels. They're there. We Now we're modeling our idea of what the market might do. And then with that model, that idea, that thesis, we then create trades that are coincident with that thesis. In other words, what I'm saying is we figure out where things are going to go, and then we put trades where we think they're going to go. And if they go there, we make money. If they don't, we don't. It just so happens that when you have a really volatile day like today, we can take more chances. We can fly closer to the sun, so to speak. That's the whole idea behind the name of this episode. We won't get burned when we're playing closer to the fire. So there's a lot of fire out there today. And we can play much closer to it because we're protected in that, yes, we can fix our risk, and for that elevated fire, we have the pleasure of potentially making much more profit. And that's exactly where we are today. Now, we're here sitting at about 3:15 in the afternoon. We've got 45 minutes left in the market. The reversal that we saw is now easing off a little bit, and we may be now moving down back into one of our target zones. And if we do, that'll be wonderful. We'll make a maximum profit. We'll do great. If it doesn't, we still have that risk that we put on in the initial portion of the trade, that we can never lose more than that. Now, unfortunately, the way some people will take a day like today is an opportunity to push all the chips in, which is really the wrong way to look at a day like today. Because you see greater opportunity is not an excuse for taking greater risk. In fact, that's the whole point. We can take the same risk and then apply it to a greater opportunity. That's the gift. That's the gift we get with volatility. That we don't have to take any more risk, but we have the opportunity to potentially make much more money. So why push the scales and try to, bend it to our will? The market is not going to bend to your will. The market doesn't give a damn about you. So you just play things the same way you play them all the time, and you take what the market's going to give you or react to what the market won't give you. There's really nothing else you can do. Now, as things stand right now, things look very optimistic. Today's trade looks like it may end up being a big, big winner. But there was a point there. Now, of course, the day's not over, so everything could change, right? There was a point there that everyone was like panicked. Oh my God, we're going to go to a max loss. Now, that expression is showing an intense attachment to the trade, an investment in your mind and soul and all that anxiety. That's not what we're trying to do here. We at Zero DTE have created a system where we put on asymmetric trades and we have an edge that we know. And with that, we can put on tiny little risks for potentially or relatively large gains. That means that if things go against us, it's not a big deal. We can take that loss. As a matter of fact, we could take multiple losses without any real harm to our accounts if we're never risking more than, say, a fraction of a percent. With that type of philosophy, and because each trade in of itself carries very little risk or very little cost, we never feel totally invested or attached to a trade. Attachment, this is my Buddhist self coming out. Attachment is the number one source of your suffering. When you are so attached to a trade, emotionally, everything is in it. That makes your mind go bonkers. You cannot think straight. You are anxiety ridden. It's nothing but static in your brain. It's horrible. You make horrible decisions. When you are completely unattached, all that suffering goes away. There's calm. There's no anxiety. There's clear mind, clear thought. And the result of clear mind and clear thought is thoughtful action, thoughtful purpose. And then you can use the facilities that are in front of you to control risk, to take profit when you need to not feel like the world's coming to an end, because you should never feel that way. You trade intelligently. So that's the story for today. This is going to be a relatively short podcast, but that's the message that I wanted to convey, that regardless of the situation in the market, those days that you have low volatility versus those days that have high volatility, we treat them exactly the same way. We apply our methods, our strategies. We take the same kind of risk each day, and we let the market tell us what is our potential. And then if that potential gets reeled in, we take it and we say thank you. If it doesn't, we say thank you. We'll wait for the next time. And so long as we do that and take advantage of our edge, we know that we will have a positive outcome in the long term. And that is the secret to trading. End of story. Peace. See you next time.